All right, folks, I hope you're ready for next week. We have a week packed with earnings, and all of these earnings are market moving events. But there are so many earnings. Like if you look at, for example, Tuesday, Visa, UPS, General Motors, Pepsi, these stocks on their own are enough to move the markets. But we have all the mega caps reporting earnings next week too, which is, that Tesla, Meta, Google, Microsoft. So although all other earnings are equally important, but these earnings will basically overshadow everything else. So let's quickly go through the calendar. So on Monday, it's pretty peaceful, so there's nothing much going on. I will not be taking any trades on Monday and Tuesday, and the reason for that is on Tuesday after market close we have Tesla reporting earnings. That's one that's going to move the markets. It's going to move Nasdaq and S&P 500. Then we have Meta on Wednesday. We have Microsoft and Google on Thursday. If you remember the last earnings season when markets were beginning to dip, Netflix and Meta, these two stocks, completely reversed the market direction. This is Netflix on 1/22, so January 22. They reported earnings. Look at this massive gap up, and then Netflix just kept going up and up from that point on. This also caused Nasdaq to go up. So that was Netflix on 23rd January, and then Meta came out with their earnings on 1st February, and they caused a similar market reaction. So one interesting thing that happened this season is Netflix, which is a market moving stock, they did come out with good earnings, subscriber beats, everything else, but look what happened. So this market reaction, in my opinion, is very important because that represents market sentiment. So when good earnings are not able to keep stocks up and they sell off, that usually points to an earnings season which is going to behave the same. The negative reaction to Netflix earnings is something to keep an eye on. Now, of course, if all these mega caps, Tesla, Google, Microsoft, Meta, if all of these report good earnings, all of these raised guidance, then forget about market sentiment, because the only thing that's going to happen then is markets will just go up. Let me pull up a chart of SPY. Since a pullback has already started happening, it's time for us to project downside targets. And what that means is you need to at least have some kind of idea of when markets could see a bounce. So I've been using Fibonacci retracements for creating downside targets. And what I've done is, if you remember, let me draw these Fibonacci retracements again for you. So these are the levels that we have right now in front of us. If you remember, when the markets were just beginning to dip, I had, you can go back to my videos and look at this. I had mentioned that typically 50% and 61.8% are considered major areas of support where markets can see a reversal. Now, this rally has been so fierce for the last 5 months that I had also pointed out that when I made that my earlier videos, we were somewhere over there. And if you go back last 5 months, you will see that the rally was so fierce that didn't even see a 2% dip in the market for 5 months. So market would drop for a day or two, and the dip buyers would come in and just everything would get bought up. So we just kind of got accustomed to the buy the dip scenario. So during that time, when we saw that first dip happening, it was inconceivable that we could go to 50% or 61.8% retracement. So I had mentioned that 38.2% retracement could be a level where markets could see support. That didn't happen. Even after good Netflix earnings, that didn't happen. So now we are at exactly 50% retracement level. So just be aware that markets are at that level of support where we could see a bounce. It all depends on earnings, how good the earnings are. Another thing I would want to point out is when using Fibonacci retracements, it's best to use areas of confluence. And by areas of confluence means that just don't rely on Fibonacci retracements. Look for other factors that may coincide with areas of support and resistance. And two areas I can see is at the 61.8% retracement level, there is a slight support here, but the real support is actually around 78.6 retracement. So if the earnings are kind of mixed, so all the mega caps don't report some crazy blowout earnings, then since the sentiment has shifted and we are currently in a sell the rip scenario, so every time markets try to rally, they get sold off. The most likely level for SPY is 478, which I'm showing you that there is a significant area of support around that area. So that is what I'm looking for. It depends on earnings. So if you get either mixed earnings or bad earnings or disappointing earnings, that's when I expect SPY to fall to 478 before it sees any kind of bounce. Now, if we do get good earnings, good guidance next week, then markets can just reverse from here. Okay, so here is another perspective of what's happening with the market. So since we are talking about downside price targets, so currently we are already down 5.7% from all-time highs. So the next downside price target is, and these are based on support and resistance levels. The nearest support is 6.5% pullback, which is 489. Now, if all the mega caps report bad earnings next week, I expect markets to quickly go down to the next level, which is around here, which is the next significant support level, which is a 9% pullback. Now note that even this doesn't represent a correction. A correction by definition is 10% or more drop in the markets. So a real correction will happen if the market's SPY drops to 467, which is this area that I've highlighted for you. As of today, there's no point projecting any further downside targets, but I have highlighted those for you, like 13.4 correction, 18% correction. Corrections of these magnitude are pretty normal in a bull market. So this being an election year, in election years, I think pre-election year and the election year, I was looking at the history, have been 100% positive for the markets. So I do expect markets to end up higher this year, but it's not going to happen until we get a significant correction, and that is what these levels are, the 13.4 or 18% correction in SPY. This is what will get us there. So it's needed, these corrections are needed, these resets are required for markets to be able to continue going up. Okay, now let's talk about VIX. So if you have been watching my market outlooks, one thing I had been talking about is that if VIX trades above 16 and trades in that region for a few days or at least a week, that is when we'll get a correction. Now, given that we have all these crazy earnings next week, there is no guarantee what's going to happen in the markets, but VIX is at that level. So VIX has been trading above that, and like, who would have thought that VIX would actually go above 21? Look at this massive spike after Netflix earnings. So VIX is actually above 21. These are the levels which usually coincide with corrections. Okay, so in my weekly outlooks, I do bring up these RRG charts also known as relative rotation graphs, and all they show you is how the money is flowing in the markets and which sectors money is coming out of, which sectors money is going into, and so you can make informed decisions on how to take trades. So one thing I've been pointing out for months is until XLK, which is the technology ETF, enters the lagging area, do not take bearish trades on tech. And we are finally seeing, it sounds unbelievable that XLK is entering lagging area, but depending on what happens next week, we are actually in that zone where you could start taking bearish bets on tech. So depending on how the next week unfolds, so we have Tesla on Tuesday. I'm guessing we'll see disappointing earnings from Tesla because everything is, their price cuts, analyst downgrades, everything is pointing to that. But I'll not be making any big trading decisions based on Tesla earnings. I'll actually be waiting for Meta and Microsoft because these are the market leaders. So once I see their earnings, I'll start indulging in more bearish trades. The relative rotation graphs, frankly speaking, don't hold that much value this week because it's such a crazy week full of all these earnings events which are going to wreak havoc on the markets. But I just wanted to point out real quick that finally tech is entering that lagging sector. So just watch out for that. That's it. That's the update for this week. There is no point going too much into technical analysis this week because it really all depends on how the mega caps report their earnings.